Welcome to this deep dive, and today we're going to try to answer a question that I think we've all wondered at some point. Why do people make financial decisions that seem, well, maybe a little bit crazy?
That's a great question.
And luckily, we've got Morgan Housel's The Psychology of Money as our guide for today.
Perfect. That's a good one.
Yeah.
It's interesting because the book really kind of flips the script on how we look at these decisions, you know? Instead of just labeling them as just crazy, he makes the argument that everyone's choices, they actually make sense to them.
It's all about context then, right?
Exactly. You hit the nail on the head. Our financial decisions, they aren't made in a vacuum, They're shaped by our unique experiences, our upbringing, the economic times we've lived through.
So what might seem like a totally reckless gamble to one person could be a perfectly rational choice to somebody else.
Yeah, he really brings this idea to life with the story of Ronald Reed. He was a Vermont janitor who secretly amassed an $8 million fortune.
Wait, hold on, a janitor. With an $8 million portfolio.
Yeah.
How is that even possible?
Well, Reed was incredibly frugal, saved diligently, and invested consistently in blue chip stocks over, decades. He really understood the power of compounding. He let time just work its magic,
That's a pretty powerful illustration of how much building wealth comes down to your mindset, not just your income, right?
Right.
Like you wouldn't expect a janitor to become a multimillionaire, but, with patience and discipline, he did it.
It's a good reminder that we often judge financial success just based on outward appearances. We see someone's job, their car, their house, and we make assumptions about their wealth. But in reality, we're only seeing the tip of the iceberg.
And this idea of context shaping our financial decisions, it's not just anecdotal, is it?
No, not at all.
Housel backs up with some really interesting research too.
Absolutely. Yeah. He cites a study, it analyzed 50 years of data on how Americans manage their money. And the researchers found that people's investment decisions are heavily influenced by the economic climate they experienced in their early adult years.
Yeah.
Those formative years.
Yeah, I can see how that would make sense.
Total.
Like if you came of age during a period of crazy hyperinflation, you'd probably be wary of bonds later in life.
Yeah.
Even if, inflation is under control.
Exactly. Our personal history, those formative experiences, they can have a more powerful influence than even the most sound financial advice. You see this play out, time and again in the financial world. Even someone like Bill Gross, renowned bond manager, he admitted his success was largely due to just a generational decline in interest rates.
But that decline, that was like a stroke of luck, right? It wasn't something he could have predicted or controlled.
That's right. Which brings us to another really crucial element of Housel's argument. The role of luck and risk in financial success. Sometimes, we give ourselves too much credit or too much blame for outcomes that are largely influenced by factors outside our control.
He uses the example of Bill Gates to illustrate this, doesn't he?
Yeah. While Gates is undeniably brilliant and driven, Housel points out that pure luck played a pretty significant role in his path to success. As a teenager, Gates just happened to attend one of the very few high schools in the world that had a computer. That chance occurrence, gave him a massive head start in the burgeoning tech world.
But doesn't that downplay the importance of hard work and talent?
Not necessarily. It's more about acknowledging that both skill and luck contribute to success. We often focus on the stories of these wildly successful people and try to replicate their steps, but we forget that those chance encounters and random events often play a pivotal role.
So are you saying we should just throw up our hands and leave it all to fate?
No, not at all. But understanding the role of luck can help us avoid judging ourselves and others too harshly for financial outcomes. It encourages us to be more humble, to recognize that sometimes things just happen.
I guess it also makes you appreciate those fortunate moments, when they do come your way.
Absolutely, yeah. And on the flip side, it helps us cope with setbacks and failures, like recognizing that sometimes, bad luck just deals you a bad hand.
It's like that saying, I'd rather be lucky than good.
Exactly. Housel also contrasts Gates' incredible luck with the tragic story of his equally talented friend, Kent Evans. Evans actually died in a mountaineering accident before he even graduated high school. It's a stark reminder that risk is always present. And sometimes, despite our best efforts, things can go terribly wrong.
It makes you realize that financial success isn't just about making smart decisions, It's about surviving those inevitable curveballs that life throws at you.
Absolutely. And that brings us to another key theme that Housel emphasizes, the power of compounding.
He calls it the eighth wonder of the world.
Yeah.
Why is he so obsessed with compounding?
Because it's the key to building wealth over the long term.
Yeah.
It's the principle that those small, consistent gains, they can accumulate into extraordinary results over time. It's not about getting rich quick,
Yeah.
It's about letting your money grow steadily over decades.
He uses the example of Warren Buffett, right?
Yes. Buffett's a perfect illustration of how compounding needs time to work its magic. Most of his wealth was actually accumulated after his 50th birthday. It's like a snowball rolling downhill.
Yeah.
It gathers momentum as it goes.
That's encouraging, For those of us who feel like we're starting late in the game, you're saying it's never too late to start investing.
Exactly.
And benefiting from compounding.
That's the beauty of it. Even if you don't have a lot to invest right now, starting early and being consistent can pay off in a big way down the road.
This really challenges the idea that you need to be a stock-picking genius or chase the highest returns to build wealth.
Right. Yeah, Housel actually contrasts Buffett with Jim Simons. Simons is a hedge fund manager who's known for his extraordinary annual returns. But because Simons started investing later in life, his net worth is significantly smaller than Buffett's, despite those higher returns.
So the takeaway here is time is your greatest ally in building wealth.
Precisely. It's not about finding the next hot stock. It's about having a solid long-term investment strategy and just letting compounding do the heavy lifting.
But for compounding to work, you have to stay in the game, right?
Yeah.
You need to avoid making decisions that could wipe you out financially.
Exactly. And that leads us to another crucial point, survival.
Yeah.
Housel argues that financial success hinges on staying in the game long enough to let that compounding work its magic. And that means minimizing the risk of financial ruin.
He calls this having room for error, right?
Yes.
Essentially, building a buffer to protect yourself from unforeseen circumstances. And let's face it, our own bad decisions.
It's about acknowledging that life rarely goes according to plan, right? Unexpected events happen, markets crash, we make mistakes. Having room for error helps you weather those storms and come out stronger on the other side.
So how do you build in this room for error? Does it mean playing it super safe? Keeping all your money in a savings account?
Not necessarily. It's more about being mindful of your risk tolerance, not overextending yourself financially and having a safety net in case things go wrong.
So this could look like, having an emergency fund, being strategic about debt.
Right.
Not putting all your eggs in one basket.
Exactly. It's like having a financial cushion that allows you to bounce back from setbacks without completely derailing your long-term goals.
So in essence, it's more about protecting yourself from ruin than chasing, those risky high returns.
Exactly. Sometimes the best offense is a good defense. By minimizing the risk of that catastrophic loss, you're increasing your odds of staying in the game long enough to let compounding work its magic.
That's a powerful lesson and one that's often overlooked in the pursuit of, getting rich quick. It's more about building a solid foundation that can withstand the inevitable ups and downs of the market.
Absolutely.
Right.
Yeah, and it's about recognizing that sometimes, the best investment decisions are the ones that help you sleep well at night.
Which brings us to another interesting concept that Housel explores. It's the idea that it's okay to be reasonable, not always rational.
Yeah, he argues that while we should strive to make sound financial decisions, based on logic and data, we also need to acknowledge that we're human beings, right? We have emotions and biases.
We're not robots. We get scared, we get greedy, and we sometimes make decisions based on, gut feelings rather than spreadsheets.
Yeah, and that's okay, as long as we're being pretty reasonable, as Housel puts it. It's about finding that balance between logic and emotion, making choices that we can live with, and stick with over the long haul.
I like that. It's a much more realistic approach than trying to be perfectly rational all the time.
Right.
Which, come on, who can do that?
Housel even uses the example of Harry Markowitz. He's a Nobel laureate, known for his rational portfolio theory. And even Markowitz admitted that when it came to his own investments, he didn't always follow his own theory. He made choices based on what felt right, on minimizing his potential regret.
It's pretty relatable. Sometimes what looks good on paper just doesn't feel right in your gut,
Exactly.
and you have to go with your intuition.
Yeah. And sometimes being reasonable means prioritizing peace of mind over maximizing returns. Like, for example, some people just prefer to invest in companies they understand or that align with their values, even if it means sacrificing some potential gains.
So it's not just about the numbers.
Right.
It's about finding a balance that works for you, one that allows you to, sleep well at night and stay engaged with your investments.
Exactly. Personal finance is deeply personal. What works for one person may not work for another. The key is to be self-aware, to understand your own motivations and biases, and make choices that are consistent with your values and goals.
So we've covered a lot of ground here.
Yeah.
We've talked about context, luck, compounding, survival, and the importance of being reasonable. And all of this kind of leads to a pretty fascinating question. If our financial decisions are so heavily influenced by, our personal experiences and emotions, how do we make sense of the stories we tell ourselves about money?
That's where we'll pick up in part 2. Stay tuned. Welcome back to our deep dive into the psychology of money.
Thanks for having me back.
Last time we were talking about how our personal experiences shape our views on money.
Right.
But even with that understanding, it can still be kind of confusing to figure out what truly matters when it comes to building wealth.
Yeah, you read all these articles about the right way to invest, the best strategies for saving.
Right.
And it's easy to get overwhelmed.
Absolutely.
I like how Housel doesn't just preach from, some ivory tower.
Right.
He shares his own personal approach to money.
Yeah.
And it's refreshingly down to earth.
He's very open about the fact that, financial independence has always been a primary goal for him and his family.
Okay.
Not necessarily to, stop working altogether.
Right.
But to have that freedom to choose the work they do, the people they work with, and the schedule they keep.
That's a kind of wealth. A lot of people, they dream of that, but aren't sure how to achieve it. I think a lot of people assume you need a massive income to get to that point.
Yeah.
But Housel seems to suggest it's more about aligning your lifestyle with your values.
He talks about how he and his wife made a conscious decision to, establish a comfortable lifestyle early in their careers.
Okay.
One that wasn't extravagant, but met their needs.
Okay.
And the interesting thing is that even though their income has grown significantly over the years, they've largely maintained that same lifestyle.
So they've been able to dramatically increase their savings rate as their income has grown without feeling like they're, depriving themselves.
Right. It's a good reminder that wealth isn't about keeping up with the Joneses. It's about having options and peace of mind.
Right.
It goes back to something we touched on earlier. The idea that wealth is what you don't see.
Yeah.
It's not about the flashy purchases.
Right.
It's about having that financial cushion that allows you to live life on your own terms.
Speaking of investments, I'm curious about his actual investment strategy. Did he share any secrets for beating the market?
Actually, he favors a surprisingly simple approach.
Okay.
He's a big believer in index funds.
Really? That's not exactly like the exciting high-stakes world of finance we often hear about.
Right. He acknowledges that there are definitely skilled investors out there
Right.
who can consistently outperform the market.
Yeah.
But for most people, trying to beat the market is a losing game.
So instead of trying to pick individual stocks or time the market, he's advocating for a more passive, long-term approach.
Exactly. He believes it's more important to find a strategy that you understand, that aligns with your risk tolerance, and that you can stick with for the long haul.
That makes a lot of sense.
Yeah.
But I think it's easy to forget that this idea of, long-term investing, of saving for retirement, it's a relatively new concept in human history.
That's a really good point. And Housel actually dives into this in a fascinating section on the history of the American consumer.
Okay.
It's a section that I think really illuminates those forces shaping our current financial landscape.
Yeah.
He argues that to understand how we got here,
Right.
we need to look back at those pivotal moments that shaped American consumerism.
Okay, let's go back in time then.
Yeah.
Where does this story begin?
Housel starts with the end of World War II,
Okay.
a time of immense change and uncertainty for America.
Right.
You had, millions of soldiers returning home from war, needing to reintegrate into civilian life. And the nation as a whole had to figure out how to transition from a wartime economy to a peacetime one.
It sounds like a recipe for chaos. I can't even imagine the anxiety people must have felt.
But amid all that uncertainty, something remarkable happened.
Okay.
A productivity boom.
Okay.
The technologies and manufacturing processes that had been developed during the war were now applied to consumer goods.
So instead of producing, tanks and airplanes,
Right.
factories started churning out cars and washing machines.
Exactly.
Wow.
This led to an explosion of new products, and Americans were eager to buy, fueled by pent-up demand and access to credit, which was becoming increasingly available.
So this was the birth of the American consumer culture that we know today.
In many ways, yes.
Okay.
It was a period of shared prosperity with gains distributed, relatively equally across income levels.
But that didn't last forever, did it?
Unfortunately, no.
Yeah.
By the 1970s, inflation started to rise, interest rates climbed, and the sense of unease kind of settled over the nation. The economic tailwinds that had propelled the post-war boom began to fade.
And that's when things started to shift.
Right. The economy continued to grow, but the gains were no longer as evenly distributed.
Okay.
A smaller percentage of Americans began capturing a larger share of the wealth.
And what about the expectations of, a high standard of living? Did they adjust to this new reality?
Not really. Americans continued to aspire to that same level of consumption, even as income growth became more uneven.
Mm-hmm.
This led to what Housel calls the big stretch,
Okay.
a period where people increasingly relied on debt to finance their desired lifestyle.
It sounds like a recipe for disaster, trying to maintain a lifestyle you just can't afford.
It's a pattern that has played out, repeatedly in American history.
Yeah.
Think back to the dot-com bubble we discussed earlier.
Right.
That was fueled in part by this same desire for rapid wealth and a willingness to take on excessive risk.
So we see these cycles of boom and bust driven by a combination of, economic factors and psychological impulses.
Exactly.
Right.
And those cycles are often intertwined with these powerful narratives
Yeah.
about what it means to be successful.
Yeah.
What constitutes the American dream.
And those narratives can blind us to, the risks we're taking or the unsustainable nature of our choices.
Right. Housel argues that this is especially true in the current era,
Okay.
which he dubs, this isn't working.
This isn't working. Okay.
It's a time where many feel disillusioned with traditional paths to financial success.
Mm-hmm.
They see a system that seems rigged against them,
Yeah.
where the odds are stacked in favor of those at the top.
That feeling is understandable.
Right.
But it can lead to impulsive decisions, a search for quick fixes,
Yeah.
or a rejection of, long-term thinking.
It's crucial to recognize these feelings and to challenge the narratives that are fueling them.
Right.
We need to understand how our expectations and beliefs, shaped by, these historical forces,
Yeah.
can lead us astray.
So how do we break free from these cyclical traps
Right.
and create a more sustainable path to financial well-being?
Housel doesn't offer, easy answers, but he does suggest a few key principles to kind of guide us.
Okay.
Firstly, he emphasizes the importance of saving.
Okay.
It might sound simple, even boring,
Right.
but it's the bedrock of financial security.
It's about delaying gratification, right? Not spending everything you earn so you can build a cushion for the future.
Exactly.
Right.
It's about creating that room for error we talked about earlier.
He also stresses the need for, patience and long-term thinking.
Right. He reminds us that building wealth is a marathon, not a sprint.
Right.
We need to resist the urge to chase quick returns or get caught up in market hype.
Yeah.
Instead, we should focus on building a diversified portfolio and letting compounding work its magic over time.
But even with a solid plan, investing can be, an emotional roller coaster. How do we deal with the inevitable ups and downs in the market?
That's something we'll explore further in part 3, where we'll discuss some of Housel's more counterintuitive ideas about managing risk and embracing uncertainty.
Welcome back to the final part of our deep dive into the psychology of money. We've been unpacking some really insightful concepts about how our past experiences and emotions influence our financial decisions, and now I'm curious to explore what Housel has to say about managing risk and dealing with that uncertainty that's kind of inherent in investing.
Yeah, he offers some truly counterintuitive ideas in this area. Like, for instance, he cautions against assuming we have too much control, over our financial lives. He uses a really striking analogy to illustrate this point.
Okay.
Imagine an alien, observing the 2008 financial crisis from space.
Okay.
From that perspective, they wouldn't see any physical changes on Earth, no buildings collapsing, no armies marching.
But but we all know the economy was like in free fall.
Right.
So what caused such a dramatic shift if there were no visible changes?
It was the stories we told ourselves about the economy that changed.
Okay.
The narrative of a stable housing market and responsible lending practices, it just crumbled.
Right.
That loss of confidence, that shift in perception, it rippled through the entire financial system.
It's a powerful reminder that so much of our financial reality is shaped by our perceptions, our beliefs, the narratives we buy into.
And it underscores the fact that control, especially in a complex system like the global economy, is often an illusion.
Right.
We can make plans and analyze data all we want, but we can't predict every twist and turn.
That can feel pretty unsettling.
Right.
If we can't fully control the outcomes, how do we navigate this inherent uncertainty?
Alice suggests we need to embrace it, not fight it.
Okay.
Instead of trying to predict every possible scenario, we should focus on building resilience and adaptability into our financial lives.
So it's about having that margin of safety, that financial cushion we talked about earlier to help absorb those unexpected shocks.
Exactly. And it's also about cultivating a mindset that's comfortable with change, with adapting our course as circumstances evolve. Things rarely go exactly according to plan, and the ability to adjust is critical.
This requires a real shift in perspective, doesn't it? Moving away from trying to control everything and accepting that sometimes all we can do is make the best decisions we can with the information we have at the time.
He highlights how we all operate with an incomplete view of the world. We fill in the gaps with our own narratives, our assumptions, our limited experiences.
Right.
He uses the example of his young daughter who's still learning, how the world works. She doesn't grasp concepts like bills or retirement.
Right.
But she forms a coherent understanding of her world based on the information she has.
And in a way, we're all doing the same thing.
Right.
We're constantly trying to make sense of our experiences
Yeah.
and creating stories to explain them.
The danger is that those stories can sometimes blind us to alternative perspectives.
Right.
Or new information that challenges our assumptions.
That's why it's crucial to be open to different viewpoints,
Yeah.
to challenge our own closely held beliefs, and to be willing to adjust our thinking as we learn and grow.
Absolutely.
That definitely resonates with me. I've had to learn the hard way that overconfidence, especially when it comes to money, can be costly.
Housel emphasizes that humility is key, both in managing our finances and in navigating life's complexities.
Right.
He reminds us that personal finance isn't just about the technical aspects of investing or budgeting. It's about cultivating a healthy mindset around money.
It's about recognizing our limitations, being okay with not having all the answers, and making peace with the fact that we won't always make the perfect financial decision.
Right. He encourages us to focus on what we can control, our savings habits, our investment choices, our reactions to market fluctuations, and to accept that some things are simply beyond our control.
So much of what we've discussed today comes back to this idea of balance. Finding that sweet spot between logic and emotion, between risk and reward, between, planning for the future and enjoying the present.
Before we wrap up, I'd love to hear about any personal experiences you've had that connect with these principles. Have you ever had to learn a tough lesson about risk or uncertainty?
Oh, definitely. Early in my investing journey, I had this go big or go home mentality. I concentrated my investments in a few high growth tech stocks, convinced I was picking the next big winners.
It's easy to get caught up in that kind of hype, especially when the market is soaring and everyone seems to be making money.
Exactly. But then the dot-com bubble burst and my portfolio took a major hit. It was a painful lesson, but it taught me the importance of, diversification and not putting all my eggs in one basket. How about you? Have you had any aha moments that shifted your approach to money?
One of the biggest shifts for me was recognizing the importance of aligning my spending with my values for a while. I was caught in the trap of trying to, impress others with material possessions. I spent way too much on things I didn't really need or even want.
I think we've all been there at some point. It's easy to get swept up in that consumerist mindset.
Yeah, I finally realized that true happiness and fulfillment didn't come from accumulating stuff.
Right.
So I started to prioritize experiences over possessions. Now I'd much rather spend my money on travel, concerts, and creating memories with loved ones.
And I bet you find it easier to save money now that you're excited about what you're saving for, whether it's a down payment on a home or a dream trip or early retirement. Having a clear goal in mind can be incredibly motivating.
Absolutely. It's not just about saving for the sake of saving, but about creating a life that reflects your values and aspirations.
Well, I think we've covered a lot of ground today. If you had to distill all of these insights from the psychology of money into one piece of advice for someone just starting their financial journey, what would it be?
Focus on building good habits, even if they seem, small or insignificant at first. Saving even a small amount each month, investing consistently, and simply taking the time to learn about personal finance can have a profound impact over time. It's about consistency and playing the long game.
That's great advice, I would add. Don't be afraid to make mistakes.
Yeah.
We all stumble along the way. The key is to learn from those missteps and keep moving forward.
And remember, personal finance is a journey, not a destination. It's about creating a life of financial well-being that allows you to pursue your goals and live a life you love.
That's all for this deep dive into the psychology of money. We hope you found these insights as valuable as we have.
Until next time, keep learning, keep growing, and keep exploring the fascinating world of money.
And remember, it's not about getting rich quick. It's about making thoughtful, informed decisions that help you build a life of financial security and fulfillment.